Hi traders, and welcome to my video on the money flow index versus the RSI indicator. In this video, I'm going to show you how you can use either or both of these indicators to help you catch moves such as this one for over 400 pips. This is an Euro Dollar EU 4-hour chart in the MT4 trading platform. Here I have the RSI indicator loaded with the default settings of 14 periods, the 70 level and the 30 level, and I also have the MFI indicator with the default 14 periods in the 80 and 20 level. You can use this particular strategy on any trading instrument, Forex, crypto, stocks, commodities, indices, etc., and any chart time frame. I'm using the 4-hour chart here, as I said. I like to focus on the 1 hour, 4 hour, daily, weekly, and monthly charts simply because I find them to give more reliable signals as they have more price data contained within them. Okay, you can find these indicators probably already on your particular charting platform of choice. So let's cover what each one does. I'm going to zoom in to show you this. So the RSI, anytime it is in or around this area here, the 30 line, suggests an oversold market, and we may look for a move to the upside. If it is in or around the upper line, this line here, the 70 level, the market is considered to be overbought, and we might expect a reversal soon to the downside. Okay, MFI is exactly the same principles. It just uses a different calculation and also the 80 level and 20 level. But anytime the MFI, money flow index, is in or around the overbought zone, we might look for market to reverse for a sell trade. Anytime it is in or around the 20 zone, we might look for the market to reverse for a buy trade. Okay, there is more to them than just those components. You also have divergence. Okay, so divergence is basically when the indicators make higher lows, like there and there. You see these lows, low there and low there, higher low, low there, higher low. This means that we can expect a turn to the upside. Potentially, it's not going to be accurate 100% of the time, as with any indicator. And then when the indicators are making lower highs, see there, the RSI there with high there and a high there, this is a lower high. And on the MFI indicator, we didn't get the lower highs until later on. Okay, so straight away, that's our first component for which indicator is better. For divergence, if we look at this trend here, which one of these indicators showed that this trend was going to happen first? The RSI, because of the divergence there. Okay, it crossed above its overbought zone here, whereas the MFI just touched the overbought zone. That being said, it was still in or around it. However, the RSI clearly moved above this overbought zone before it started to fall. And then it made a new high here and then fell further. The MFI, well, there's actually divergence here as well, but we're going to confirm with the chart, which I'll get onto in a minute. To be fair to the MFI, it did pick this this divergence to the sell side here. It's just that the RSI would have picked out this move at a more favorable point. That being said, they both are good for telling you the same thing. The most important thing is going to be not just what these indicators tell you. Okay, they're going to be what you do on your charts, which I'm going to get to in a minute. Please stick around for that. It's very important. Okay, a lot of people think you just need to sell when these indicators are extremely overbought or buy when they're extremely oversold. I wouldn't do that. Okay, granted, there will be times when you will get in at the right time doing that. However, a lot of the time you're just going to get taken out. For example, if it crossed above here, the RSI, and you sold, the market continues up. You know, it crosses above here, oh, it's overbought, let me sell. You sell there, the market continues up. Same with the MFI. Oh, it's crossed up, it's overbought, I have to sell now. No, you don't, price continues up. Same here. Oh, it's overbought. I have to sell. No, you don't. Price continues up. And why is that? Because we're looking at the overall trend. Okay. Level of support there. That's a clear uptrend. I'm going to ignore anything overbought on either indicator unless I'm thinking about buying and it's overbought. Okay. For example, here if you saw this trend and you got excited and you wanted to jump into the trend around here, you opened up your chart, you saw, wow, it's trending, let me jump in. Both these indicators will tell you, no, don't do that. The market is overbought. Okay. Wait for the reversal. And we have a nice reversal, bang on the trend line. Both indicators have pulled back. Then that would be the entry point. Okay. Again, on the RSI divergence to the upside, and to be fair, the MFI divergence to the upside as well. So they're both telling you something very similar. Okay, the RSI is more reactive in this overbought scenario here. You can see straight away, as soon as price shot up, the RSI went into the overbought zone, whereas the MFI waited and waited, which can have its advantages and disadvantages. I mean, if the RSI is quick to tell you a market's overbought or oversold, it can also mean that you miss potential signals, which would have been okay. I mean, it wasn't, as soon as this candle started, really, we were in the overbought zone. However, that could have been a breakout entry of this resistance level. Okay, so there was actually a breakout entry into this trend when the RSI was saying, no, it's overbought, don't buy. However, the MFI was saying, look, there's perhaps some gas left in the tank, we're not quite overbought. So again, that could have been a good signal that there was still, to take the trade, there was still some left in this move. Okay, but then there are other times where the MFI may suggest, yeah, there's still gas left in the tank, but there isn't. Okay, so that would have been one way to enter into this particular trend. Again, the divergence. And if we go back to where we were here, this particular move, we've got a nice resistance level. Okay, level of support there as well. This is a double top, triple top candlestick pattern with a breakout to the downside. We also have this probably closer, this level of support up here. Okay, forming a nice wedge pattern. Got lots of videos on wedge patterns and double tops, good to be aware of. So could have entered here on the breakout there or the breakout there. Let's just say we took this breakout. Okay, so the RSI gave us the go ahead, not oversold yet, it's okay. Same with the MFI, so they both agreed there. However, the divergence of the RSI was more obvious to the sell side there. Okay, so that would have been a better confirmation, whereas the perhaps the most recent divergence on the MFI was that upwards divergence there. Okay, it hadn't quite made the lower highs as the RSI had. But then again, this is why indicators are so open to interpretation, because some traders may be drawing that. And they may say, well, the MFI is showing divergence to the downside. If you look at the bigger picture, it was actually there before the RSI did. So for safety, you can use both, a signal from both. Okay, they both have to show divergence to the downside if you're selling, or to the upside if you're buying. They both can't be oversold or overbought. If you're going to be selling, you don't want either oversold. If you're going to buy, you don't want either overbought. Granted, you may miss the odd trade, but you're going to get in at an early opportunity more often than not. Yeah, as I said, I wouldn't use them for timing entries, just because if you're looking to say this downtrend, you want to sell into this when the RSI is overbought, it's not going to be overbought. Look, it doesn't once come in this overbought zone. However, there's ample opportunities. If I just remove that, there was ample opportunities to get in on this trade. You have that breakout there from that support level, which is a support level that goes all the way back to here. Okay, you can see that's a strong level of support. That would have been an ideal entry into this trend. Yeah, support level there. Strong support level there that eventually becomes resistance. I mean, we don't need either indicators, either of these potentially lagging indicators to tell us that. The price tells us that. We can draw lines to show that. The divergence is the same. I mean, we can draw trend lines. You know, we can look at the chart and see that it's falling down. It's just sometimes indicators act as, let's say, training wheels. If you're learning how to ride a bike and you've got your stabilizers on, but eventually you just start to see these things without needing these indicators, which, as I said, can be lagging. But I do understand why some traders would want to use them for visual confirmation. It can be, you know, let's just say we had taken this trade, just to stick up for the indicators a minute. Let me just remove these levels. Just say we took this breakout. Okay, fantastic opportunity here for over 300 pips. Okay, in the space of 2 to 3 weeks. Could have had a stop loss just above here, relatively tight stop loss, and then as soon as price breaks out, stop loss break even, then as price drops, stop loss above the high there, price drops, stop loss above the high here, price drops, stop loss above the high here, price drops, and we can just trail our stop loss all the way down, and we could have really milked this move for lots of pips and perhaps closed part of the position on the way down and banked some profit. Okay, and then how does the RSI and MFI help there? Well, because when to help with our exit basically, because when it starts making higher lows, okay, this is when we're saying, okay, maybe this move's exhausted now. You certainly wouldn't want to sell yet anyway, especially not after this big move down. But you might want to consider closing all or part of your position. Okay, that's where the RSI and MFI can help. Nothing set in stone. I wouldn't say, oh, there's upside divergence, I'm gonna close my position. You know, there's other things to look out for. How does price react around this support level? It's been tested 1, 2, 3 candles here. It's been tested here. You have this hammer candlestick pattern, a bullish hammer candlestick pattern, which can signal an uptrend. But it'd be interesting to see how this plays out. We've got our trend line, like what is price going to do from this trend line here? You know, is it a bear trap? Are people going to try selling now and get trapped and price will break out to the upside? That's the potential as well, which is why it's a good idea to get in early before the RSI and MFI are sort of flirting around the oversold zone and they are showing divergence in the direction that you are looking to trade. I wouldn't necessarily say one is better than the other. The relative strength index is a really common indicator. I mean, many traders use it, which can have a self-fulfilling prophecy, but at the end of the day, it's just a reflection of price. Same with the money flow index indicator, perhaps not many, still plenty of retail traders are aware of it and using it, but it does do something really similar to the RSI. I just want to mention as well, whilst we're on this video, that these indicators can be used. I don't want to say time and entry because that goes against what I said earlier in the video, but it can help. Just to when I'm looking to enter on a trend like this, I want to enter on a pullback. Okay, so let me just remove this trend line. So as I mark the support levels as entry points before, okay. Don't forget your candlestick patterns as well. I can see a 3 inside down candlestick formation there, which may have been a bearish entry signal prior to this support level, but you probably wouldn't have sold against this support. Just wait for the breakout. It just would have been nice confirmation. I've got lots of videos on candlestick patterns such as the 3 inside down. Okay, market's making lower highs, potential entry there. Resistance level, support level there becomes resistance here, another good entry. And as I said before, by now we're getting late to the party, but still you can see from that breakout candle there, traders are watching these levels. Some look, there's no coincidence you have these big candles around these areas, because this is how traders are looking to time their entry into these trends. Okay. But what I wanted to illustrate was the pullback of the RSI and the pullback of the MFI indicator. Basically, when they come away from the oversold, can indicate, okay, let's now start waiting and looking to time our entry into this trend, because the market's having a pullback. What I'm not going to do is buy. Okay, I'm not going to buy against the trend. You know, this is a clear sell trend, so we're in sell mode. All right, we're not looking, oh, it's oversold, let's buy, let's buy. I mean, you can counter trend trade if you want, but you know, the trend is your friend, as the saying goes, just makes life a lot easier. But yeah, so if you look at these breakouts where they all happen when there's a pullback. Okay, pullback, pullback above, pullback above, pullback above, pullback above the oversold line I'm talking about. Pull back above, and that can be a good way just to gauge for extra confirmation, and then wait for the drop. You know, short-term divergence to the sell side can just give you that additional confirmation. But in all honesty, in my humble opinion, I really feel like you can just do this with marking trend lines, support and resistance, and keeping an eye on price action, candlestick patterns, and just having good money management. Okay, so would I say one indicator is better than the other? No, I wouldn't. They're very similar, in fact. I mean, you can even play around with the periods of them and they'd probably show something almost identical. It's just like when you have these fancy trend indicators, like, you know, people make up these unicorn trend indicators like there's some magic for 100% winning rate trades. They're not. I mean, a moving average will do that for you. You just chuck it on your chart and it will show you prices below bearish, prices above bullish. Simple as that. But you don't even need a moving average. You can just use your eyes or mark your highs and lows to see which direction the market's heading. Okay, well, hopefully you found something useful in this video. Appreciate you watching. Please like and subscribe for more, and I'll catch you on the next one.